Welcome back to Be Great Economics. This is Nate. Let's get started. This is going to be our weekly update. We're going to talk about transitions. Previously, the past couple of weeks, it's mostly been continuation pattern discussions, and I want to go over a couple of transition events that we've been seeing. We talked about some resistance lines that we were heading into, and then we broke through them throughout this past week. And so I just want to talk about where the risks lie in buying these rallies and where the potential lies in a blow off top or continuation patterns throughout the rest of these moves. So we're going to start with the S&P 500, and you can see that we have had a positive rally in the past couple weeks. Now, throughout this phase, we saw that there was distribution back in the fall, winter into December, and then we fell from there. And as I talked about previously, that was most definitely a form of distribution. Now, and accumulation doesn't necessarily mean that we have to go back up to new all-time highs or back to all-time highs. It could just be that we go through a distribution event and then they use the opportunity to buy dips and then sell it again as there's no faith in the market. I don't think that that's necessarily everything that we will see, but it should be kept in mind that we may see an arc pattern. If you look at the 1970s, you can see that both times that the market hit new peaks, it fell rather slowly, and that was because there was high stagflation. It was hard to have faith in the market. There was high inflation. And so while technical or technological assets could perform well, our biggest problem was that the economy itself was struggling. And so most corporations were struggling for earnings, jobs were going down, and we had two big recessions throughout that period that caused major dips in the stock market. So does a blow off top have to occur? It would be really disappointing if we don't see one. At the same time, it would be more beneficial long term to not have one. So you're kind of stuck between a rock and a hard place of it would be nice to get the benefit of the rally. The negative side would be that we would just continue on to insanity. Now, there is the alternative that the market just recovers and moves along in its happy, merry, healthy way. I don't think anyone's of that mindset, but at the same time, I have a little bit of a concern when I ask if anybody is in agreement with you and everybody is in agreement, then maybe we're on the wrong side of the trade. So right now, I think that the sentiment has still been very negative, and this is like the first really strong week of rallying. So we're going to go on to the Nasdaq here and talk about the potential for continuation. So if we went through some form of accumulation, whether it was descending accumulation or whether it is actually just starting here as a horizontal accumulation, one way or another, we've gone through some form of accumulating, and we are seeing that there is momentum available. Just like the S&P 500, you can see that the RSI has broken out, but there's still plenty of room to the upside, and that the MACD has opened up into the bullish momentum. And so I think that we're going to continue to see an uptrend overall into both of these stocks. We may not make it to all-time highs. I would look at the next set of resistance to bounce off those. I think we may burn out here a little bit, come back down. The most bullish thing would be to come back and retest a support zone. I'm going to show you the support zones real fast. Here is the Nasdaq. We're coming down through this descending line. If we come down and retest this descending line, that will be beneficial. If we do it right where it intersects here and then come off it, that will be very strong resistance held or support held. And then we go to this support line here where we broke down from this small accumulation zone and gave up, wicked down here, and then we came back and retested it a couple times at 317 on the QQQ. You can see that we kind of held it before. If we come down and we retest this zone somehow and then bounce back off, that would again be a bullish indicator. The things that are holding me back from getting completely bullish right now are volume. The market is still seeing this rally as a false rally. But I'm going to show you next why that may not necessarily be the case. We can see that the Nasdaq and S&P 500 price in the S&P 500 has come back up and is retesting into resistance, and so we should expect some type of retest back down, which would make sense because we look at the other ones and it looks like maybe we'll get a little bit of a resumption back to the downside for a little bit. We get a little bit of consolidation. But what I want to show you here is on the blow off top with on the monthly on the Nasdaq S&P 500 back in 2000. What happened? We had weekly candles that were only green this entire time. That is what we're talking about on a melt up, is like 10 straight green candles before you get any interruption of that. These can be chaotic candles, but they are basically 10 straight green euphoric candles. Now we need an event to give us that type of euphoria. We could make new all-time highs, but not necessarily have a strong blow-off top like this because we could not have enough momentum behind it, but there is enough liquidity that could come to the market. At this time, the current liquidity in the market is rather low, but the benefit to the and definitive characteristic of liquidity is that it moves rather quickly. So we could see this return, but we need to see a reason for it to return. Right now, liquidity is rather low. The Fed is tightening. They're doing a very weak job of tightening, but they are tightening. And so we are seeing that the trend is expecting a downside. Now, if the market overcorrects for this early, it may have time to rally. And so you could make some money making the trade, not necessarily an investment, making the trade on purchasing these low points. Now, if you have stocks that are down 50+% and they have a long-term outlook and you plan to hold them the next 10 years, you might as well buy here. It's a dip. But if you're going to hold them for, say, you're looking for returns in the next few months or weeks even, you're trading and you need to pay attention to these trend lines. But otherwise, valuations, I would just stick to traditional PE ratios and other common forms from there. For the government bonds, as we've gone into a raising federal funds rate, we're seeing the 10-year continue to rise at a very rapid pace. So overall, the 10-year government bond is running up and catching up to the same pricing as the 2-year. And so we're seeing the 10s and the 2 invert. And because that is occurring, it has not happened yet. We are 0.5%, I can't remember the exact number right now. But we are yeah, it looks like I think it was 0.05. This was 2 weeks ago from the one that I put up here. But just to show you that the inversion is overall occurring, we are almost there. We haven't touched the zero line yet. We have not fully inverted, but we are so close that it is tightening up some buttholes. So just be prepared for the negative attitude that can come from this. But also remember that when this yield curve inverted in 2019, we had a rally up until February 2020. And so something to think about again is that sometimes there's a little bit of a rally coming before the storm, and it's really kind of funny to see how markets react to this. In the dollar, just overall, I'm going to highlight that it has performed bullish. I think that it's a little overextended here, so it's going to have to consolidate in some way unless we get a clear liquidity crisis that's going to cause it to bust up. But I'm going to show you why I'm not exactly fully bullish on the dollar. I'm not going to say I'm going to be bearish or that these technicals are going to give me one way or the other. Right now, it looks like a bull flag can be forming, but we could be overextended and coming back down. But I'm going to show you a couple of other currencies to talk about and a couple other reasons. So for one, the dollar doesn't necessarily strengthen into rate hikes, right? Because the biggest thing is on the way into the rate hike, you're going to see a sell-off in the bonds. So the dollar can kind of feed some of that liquidity, but it's going to go into something else. People don't want to necessarily hold their dollars for this. So the rallies kick off. Generally the federal funds rate raises. Before the raise starts, we get a sell-off, right? We had it in January 99. We had it in 2003, 2005, and then this also was the housing bubble, so it really showed up there much more strongly. And then we had it in 2015, 2016, and we rallied until we gave in at 2019. And you'll notice that it goes a couple months past the peak, and then we finally decide we're going to lower rates. So right now we're going to be moving into 0.25% federal funds rate. But the bonds have already started pricing that in, and you'll see that when the rates start to run, the yields jump high. But you know where you can find where they peak out? They peak out the bonds or peak out federal fund rate when the bond yield finally peaks. Now, do you know that it's the peak each time? I don't think we have a really good way to guarantee that, but we can try to follow this trend. And if we see us come up and retest the top side, we might say, okay, the federal funds is going to be falling soon. But by then, I'm expecting that we'll see some sign of a problem arise here. But so the yields predict when it's time to lower the federal funds rate. You see they flatline it at the top here each time. So we should expect the dollar to not necessarily strengthen on this at this time. But then atop it, I saw Santiago Capital bring up, because they're dollar bulls generally, with the milkshake theory, that what if the Australian dollar and the euro fall below long-term trend lines? Well, we're actually seeing them bounce off those lines. And so here's the Australian dollar up top here on the upper left. We can see that we're holding support. We've created a W bottom. So we could come down, retest it, and then break through. But I just am not that bearish on the Australian dollar right this second. we could see something occur, but they have started hiking rates, which has kind of strengthened their currency a little bit. And then we are seeing the British pound against the USD fall below its ascending trend line. So we're probably going to come down and retest somewhere into the 128 zone from my current looks of it. But here's what I wanted to bring up is I'm bullish on platinum. And I was looking at the Australian chart and I went, wait a minute, I've seen this chart before. I can't believe nobody's ever shown me this comparison before because I watch a lot of commodity stuff. And how has nobody ever brought up that platinum looks exactly like the Australian dollar chart? So that's an interesting one. So if I'm bullish on platinum, and I think that there's a long-term, the next several year outlook, positive run on platinum, maybe I should be positive bullish on the Australian dollar. Now, they can have policy changes that make their currency weaker globally, but maybe this is because of all of their exports having an effect in it. I'm trying to figure this one out, so I'm gonna do a little bit of looking, but I have a lot of research to do for other videos. But it's just an interesting thing to note is that if you were ever bullish on one, you should probably be bullish on the other because they have a rather neat correlation here. So. We're going to go into oil and energy overall. Oil here has come up, broken above. I was definitely wrong on my assumption that we should get some type of retest into the zone back here, but left room for the error because we did have these waves expanding. We got 3 good waves, so it was time to move up. So we came down, we retested, we hit the zone that I was looking for to come back to the line and come back up above. I think that there is a probability we come and see these lines a little lower again, which would be great to see the prices stay low for a little bit. But we can't rule out current events, and like Raoul Paul pointed out, Raoul Paul, I think RuPaul's the drag character from TV, but Raoul Paul pointed out that there was a thing where he was saying that you should not trade global crises because you don't have an edge on the news feeding you information. So I am just going to stick to this charting for right now on how I view energy. I bought the dip here into some oil stocks, and I'm just going to ride out this train into the bullish territory. If we do come down into a retest and we break down afterwards, we get some volatility down. I don't expect to fall below the 76 line, maybe wick down into this zone, but more than likely we'll see a resumption back up and see an uptrend because it really does need to reprice into a zone that is a little more sustainable in pricing oil on the long term based off of cost of production and availability since we can't bring more online right now. Uranium, I have been bullish here. I had buys in here and here, and so far I've felt good about these moves. Sorry, this breakout and this breakout. I felt good about these moves, and then I decided with this move I should look at Elliott wave maybe. We see that we didn't break below the 2 to 3 move. We had the 1, 2, 3, 4, 5 wave, and we did in fact make the 5 wave longer than the 3 wave. And so we could be done here. We might get an extra up thrust at this point, but I would expect if this was an Elliott 5 wave, we should get an Elliott 3 corrective wave, ABC wave. And that I think would take us back down into the 24-22 range before we resume back up. I think this last rally was fed by a little bit of that Russian export limitations news that was being hyped, and again, global event trading problem. Don't necessarily buy that news. It was the same thing as when they were talking about how Kazakhstan was having a bunch of riots and revolts, and so that pumped the price here. I would say that this is the result of that final kind of Russian news price. And so if we correct back down, we'll probably find some support here and then resume back up. So I'd still remain generally bullish, but I wouldn't necessarily call this breakout a buy point at this time. So copper, whew, I wish somebody had stopped me. I bought my copper down here. Copper calls down here. I watched them go all the way up here to $5. You know, I made like 83% at one point, and I was like super excited. I'm like, man, I'm gonna make it. You know, we'll get a little bit of correction. And we fell below the line. And I was like, I'm gonna take it before it hits the stop loss. I'm gonna go early and move into silver because I have more long-term confidence in this game. And then copper ran again. So Could have taken a little bit more profit here, but it is what it is. Anyways, I would stay generally bullish on the uptrend here. We are clearly breaking out and sitting above the descending trend line for the wedge, and so I would expect to just continue up. We might hit that $6 target price if you wanted to add copper to your position. This isn't necessarily a bad zone. We do get a lot of chop. You can see how volatile this chop is, so you could get another opportunity down low. I would maybe do it in 3 tranches, giving yourself a couple lows towards these support lines, follow a line up towards 460 would probably be a good zone to look at. So, and then I'm going to bring up my chart for the gold, stock, and bond response to an inflationary environment. You can see my whole video explaining how this works from the data I collected, but it's just talking about an update. And I don't know for certain that we've moved into this next phase because I don't know that this is necessarily the top for the S&P 500, whether or not gold is going to outperform. So the graph that I drew out up in the upper right shows relative outperformance through history. So it was hard to calculate some of the different pricing functions, and they're not exact. The original chart was way more chaotic, so I simplified it down to just these key transitional moves. And so we may not get the exact same response every time, but we are going to get pretty close. And so or at least that's my hypothesis, because it's the first time I'm testing this in real time. But what we are seeing right now on the trend is we are seeing bond prices begin to fall or continue falling. We are seeing gold prices rise, and we are seeing stock prices fall as an overall trend at this time. And what I would say is that would be the transition between phase 3 and phase 4. You can see that I highlighted it in a red square here of what we should be seeing. I don't know if this was the top and we're here, or if the top has yet to come and we're really around here. If the bonds are still falling, because this is real inflation adjusted return on a 10-year yield. And so what I'm attempting to show is that the price of the bond is actually still falling, but relatively it's still very expensive. It's actually pretty close to the 2020 pricing. And so once you adjust for inflation, because when I put the regular chart, it just showed the yields falling through the floor, or sorry, the yield skyrocketing, which made it look like the price of the bond was just falling through the floor, which isn't really occurring here. It's just trying to play catch up with inflation because you've seen that it's been on a descent this whole time. And so this reversal should probably be occurring somewhere in here, and maybe it's when the federal funds rate hits its limit and falls back down. And that's when we continue back up. So every environment's going to be different. History doesn't repeat, but it rhymes kind of conversation. So I hope that that makes sense. You can watch the whole video on my hypothesis on the response of gold in an inflationary, asset protection inflationary environment. So here I have gold just showing that we've broken down from the immediate uptrend. This is a point of consolidation. We should expect this. I kind of expected it to go a little lower. I'm rather impressed. I did target 1916, which we came right down to and then came right back up. So I was like, oh, okay, we hit that. But I kind of expected it to go a little lower. So that was like my first target. So we might see it go a little lower, but I'm still bullish on gold. I think that the peak of the fear trade was back here at the beginning of March. And so we're going to have to transition into the inflation trade and less the war trade. And the war trade is going to get people very nervous. It's not necessarily as bullish for gold long term as the inflation and currency risk trade, which takes more time and more education. So it takes more to get that momentum building, but it's more powerful. And I have been super happy with the action here in silver. The only thing at this point in time that I am nervous about is that if we see some type of falter here, because I really would not be expecting this one. And so be prepared for anything. We broke down from this downtrend. If we break below if we break below and reject off the peak here, I would get concerned because maybe we're not done. Now we saw the volume shoot up, but this would be very weird to me. So I'm not going to necessarily say this is a good dip to buy if you have a long-term bullish thesis and you're not certain if the downtrend from here will go. We know that the premiums are really high on silver, And so maybe PSLV is your better arbitrage play until there's better pricing into silver, or you can purchase some miners or something like that because this rebound has given them a little bit of a loss. The SILJ has finally started outperforming silver to the upside, and so I'd expect that to continue for a little while. But overall, I still remain bullish on silver. I'm just going to watch my risks because the TA isn't necessarily, the price action isn't necessarily instilling a ton of confidence in me at this point in time, but overall, silver does tend to be a little bit of a stronger whipsaw. So I will accept this for what it is at this time. Bitcoin. So this one's been exciting to finally see. This is the first time I've added spot yesterday. The first time I've added spot since I think September because, well, I added spot into the dips. It's the first time I fully positioned all of my stable coins back into Bitcoin, if that makes sense. I am now fully positioned as much spot Bitcoin as I'm willing to hold at this time, because after we broke down this line in September, I said, okay, this is too much of a painful risk here. I'm going to drop out. And then I bought cash spot into these dips on my crypto.com app, but I have not done any leverage. I still stay out of leverage right now because I don't have a positive outlook until we get solidly above 45,300, 45K. But overall, if this is accumulation, we're seeing volume ascend, and I feel good about that. Now, I didn't like that the volume ascended here on the sell-off, but then we didn't see that repeat. We did see volume descend on this ascent, and that worried me. But then yesterday we got the bullish candle again on an uptrend, and I was like, okay, all right, so the market's shifting. That doesn't mean that a blow off top or a run up is imminent, but the market is shifting its sentiment on Bitcoin. So since we're seeing a better positive impulse, this is one of the first times that I feel good about an ascending RSI. We're seeing a break opening and ascent in the MACD, and so I would say that I am generally seeing the price action finally supportive of the expectations of on-chain. So on-chain took a while to reach into reality that we are starting to see a low supply event occur to actually have an effect on Bitcoin. And then I'll highlight Ethereum here. It's the same, Ethereum priced in Bitcoin showing kind of the same action where we're finally breaking out of a downtrend this time. We'll probably come back down and retest, and that could occur because Bitcoin maybe rallies first, which is kind of what we should see, and that would be great. But it could also occur because they both kind of fall again. So just be prepared for that. I also highlighted Chainlink down here because this is one of my favorites that I did add. This is also the first time I've added altcoins other than Bitcoin and Ethereum since September. And so I added Chainlink to the mix again because this is really low priced. Worst case scenario, I mean, I bought most of my Chainlink at an average of like 7 to 12 is when most of my big buys were in. And we've bounced back down to 14 or so yesterday when I got some, so it was like 14.70. So I think that right now it's a better place if you have a long-term outlook to be accumulating in this zone finally. Sadly, I don't have as positive a look on Chainlink. We see, and in that case, many other alts. I'm just using this one as a proxy. You're seeing ascending RSI. You're seeing an ascending and opening positively MACD. And we are seeing, but we aren't seeing an alt's volume necessarily pick up, which is kind of good because we should expect it to go Bitcoin, Ethereum, large caps like Chainlink, and then small cap, micro cap, right? We should see that chain effect continue on down. And so if we aren't seeing that happen in altcoins yet, it means that altcoin season isn't here yet. So this should be an accumulation point for altcoins too. If you were accumulating Bitcoin, your safety ones during this downtrend, now may be a time to go, let me look at my altcoins, let me see the value of them. So thanks for watching. I hope that makes sense. Overall, I see that there is a kind of positive trend in most of the markets right now. I think that throughout the rest of the week that could sustain. We might see a little bit of retesting in things like the S&P and the Nasdaq. And then the currencies seem as though being too bearish on almost any of them doesn't seem like the right move at this time. So thanks for watching. I'll see y'all next time.